Welcome to Conversations, Season 2 of the MTA Podcast Series, a weekly audio cast featuring interviews with leading investment strategists, geopolitical experts, and other key thought leaders, brought to you by the Market Technicians Association, and your host, Ed Carlson.
But it should be noted that the first Republican gains against President Roosevelt came in the midterm elections of 1938. And it should be noted that the stock market rallied strongly in 1938 on the day after that Republican victory, and then never traded at that price or higher again for 7 years. Tuesday, November 9th, 2010, this is Conversations, the official MTA podcast series, Season 2. And today's guest is Larry McMillan. Professional trader Lawrence G. McMillan is probably best known as the author of Options as a Strategic Investment, the best-selling work on stock and index option strategies, which has sold over 200,000 copies. An active trader of his own account, he also manages option-oriented accounts for certain individuals. In a research capacity, he edits and contributes to his firm's publications, Daily Volume Alerts, The Option Strategist, and The Daily Strategist, derivative products newsletters covering equity, index, and futures options. Finally, he speaks on option strategies at many seminars in the United States, Canada, and Europe. He is quoted in publications such as the Wall Street Journal, Barron's, Technical Analysis of Stocks and Commodities, Data Broadcasting's Exchange Magazine, Futures Magazine, TheStreet.com, and Active Trader Magazine. In these capacities, he is the president of McMillan Analysis Corporation, which he founded in 1991. Prior to founding his own firm, Mr. McMillan was a proprietary trader at two major brokerage firms, primarily Thompson McKinnon Securities, where he ran the equity arbitrage department for 9 years. Larry McMillan, welcome to the program.
Thanks a lot, Ed.
You bet. Well, thank you for taking the time to join us. Larry, we always start these podcasts with some personal background. I know people are always interested in where the names I've been hearing for years came from. Maybe you could take a few minutes and give us some background on where your family's from, where you grew up, where you went to school, what you majored in, and how you made the transition to option strategies and technical analysis.
Well, all right. I originally from Indiana, went to Purdue, and then the Army, then graduate school at the University of Colorado, and ended up working for Bell Labs in New Jersey as a software programmer at the time. But I also, that was just about the time options were getting started. The first listed options were traded on the CBOE in 1973. Okay. Then I was trading my own account at the time, and, my broker heard about that, called me up, and he said, hey, you ought to take a look at this stuff, because it was very math-oriented, which, that my degrees were in math and computer science. So I started doing that. I started writing a newsletter on the side, even while I was still there. Interestingly, Ivan Boesky was one of my subscribers.
Who was?
Ivan Boesky.
Oh.
Anyways, about 3 or 4 years later, I decided to go to Wall Street and get the retail analyst job at an option analyst in the retail department at Thompson McKinnon. And about 3 years after that, I started trading the firm's money.
Oh.
So, and I did that for another 10 years or so. So that company went out of business. But, I really got into it because of the technical and the mathematical aspect of it. Because options being a derivative security, you definitely have, it's sort of a math-oriented game.
Sure.
Although I know a lot of people don't play it that way, but, I think that's the proper way to play it.
Okay. All right. Larry, you sent me a fair amount of research, and there's some items in there I want to dig into during the next 20 minutes. However, before we get there, I thought it'd be interesting to get your thoughts on what happened last Wednesday. The Fed announced just how much money they were going to be putting into QE2, and on that we saw an initial sell-off, but the market ended with a small gain. And it wasn't until the next day that we saw a monster move in the equity indices. And I'm curious, what do you think was going on during that 24-hour period?
The actual news itself was pretty much in line with, I think, what people had expected. So those who had chosen to buy in advance of the news were probably sellers right after the news. That's fairly common to buy on the rumor and sell on the news.
Mm-hmm.
But they were sort of neutralized out by other buyers who were kind of trickling in. But I think the next day when people who were on the sidelines, people who might have been in, let's say, bond funds or other things, decided that they took a second look at it and decided that, the government was really in here to inflate things, so they better buy some of those things, whatever they might be. And I think that was the delayed reaction by, sideline money. Just took it, took it overnight or at the morning meeting or whatever it is before they actually got in.
Well, exactly. The futures were up, 20 points before the cash indices even opened. Who's playing that game? Who's driving those markets up overnight? Is that foreigners or what's going on there? Do you know?
Well, I mean, specifically, you kind of have to look at each time that it occurs, but I mean, it's certainly not retail. Let's say
right.
Yeah. So I mean, a lot of times you'll have trading desks that are getting orders overnight to buy in the morning, and they'll start buying the futures on Globex to, counter that year or two. I mean, it's not illegal to do that, but it's sort of like front running. But
well, yeah,
but that's not illegal. So if they have to facilitate those orders in the morning, in other words, they have to sell stock to the customer. They've got themselves hedged with futures.
Got it.
But and it's still, it's a game where a lot of us don't have the same information that a lot of others do. So, or that a few others do, let's say.
Right.
So it
right.
makes it an uneven playing field in that regard. But on the overall, I guess, aspect of things, it wasn't all that surprising that people finally decided, hey, maybe we just better run with this thing for a little while.
Yeah, don't fight the Fed.
Yeah. Well, yes and no. I mean, normally I would say that's true. The Fed is just in the business of providing liquidity and doing the normal things of running the business cycle. There seems to be a little bit of an outlier from that, so I'm not exactly sure that mantra really holds, but everybody's still saying it right now, at least through today. But if the thing starts to break, I think there'll be a lot of people trying to squeeze out the extra at the same time.
Yeah. It sure seemed like every technician I follow was pretty negative going into that, and so there were a lot of folks that were surprised by that. Do you have any thoughts on that?
So, we follow a few things. I mean, in the option market, the two big sentiment indicators that we look at are volatility levels and the put-call ratio. The put-call ratios have been bullish and are staying bullish, so that's not a real concern to us yet. The volatility levels are somewhat of a different thing. What we have right now is actually a very low actual volatility because the market has been advancing but in a very steady pace, so that creates low volatility. But traders have been paying up for options, so that's what they pay for an action is really the implied volatility of the action. So there's a big discrepancy between actual volatility and implied volatility. And usually when that happens, you get a very volatile market reaction soon thereafter. And sometimes it's on the upside, probably more than often though it's on the downside. But this market is going to be volatile for a while. I'm pretty sure of that.
Mm-hmm. Well, that's actually, I had that in my notes to ask you about that, the difference between implied volatility and actual volatility levels and how you played that game. I thought that was real interesting. You had referred to it in some of your research. Where does a person or can a person access actual volatility the way they can find implied volatility with the VIX?
Right. Well, actual volatility is just the standard deviation of it's actually just how fast the stock has been moving around in the past. So there are a number of ways to access it. I mean, we have an area on our website, for example, that has it. We call it the strategy zone. There's a free trial for that, and we give you 10, 20, 50, and 100-day historical volatilities of everything that trades options. So every stock, every index, every futures. And we also did the implied volatility. But a lot of people just will calculate their own, at least as far as the SPX goes, the Standard & Poor's 500 index. And right now what we're seeing is the 20-day historical volatility of SPX. Last week, actually, at one point, it actually fell to 8%. That's so low that it's dangerous. And typically when it falls that low, you should be lightening up. Because once it gets back above about 13, the market usually takes off to the downside pretty quickly. But we're in a strong uptrend right now, and there are people, as you say, that are using that don't fight the Fed philosophy. So perhaps a better thing to do would be to wait for a combination of, let's say, historical volatility rising above 13 and SPX falling below the 20-day moving average, or some sort of price-confirming signal like that before you actually, sold stocks or went short or whatever it is that you're thinking about doing. But, there are definitely some danger signs in the market right now, and that's, I think, primarily one of them is that the last two times that the volatility got this low was last January and last April, of course, right before the market.
Right. Okay. Yeah. We're going to continue with Larry McMillan in a moment, but first a reminder that on next week's program, we'll have S&P's technical analyst Mark Arbiter as our guest. Okay, Larry, another item I wanted to ask you about, you spill a lot of ink in your reports discussing the term structure of VIX futures. I think our listeners would be interested in hearing more about what you're doing with this information. And I don't know, can you give us a primer on the term structure of VIX futures?
Okay. Basically, it's just the term structure means, for those of you who are not familiar with futures trading, it's just the relationship of the various futures contracts to each other. So at this particular time, VIX is very low. So VIX itself, is running right around 16. Let me see, where are we? 18. VIX is around 18. As I said previously, the 20-day historical volatility is down around 10. So that's a big discrepancy right there. But then the first futures month is November. Those expire next week, so those are also near 18 because any differential between the November futures and VIX has to disappear by next Wednesday.
Yeah.
Then the next month is December. That's about $2.20 higher. And then January after that is about another $3 higher, and then February after that's another $1 higher, and March after that's another $1 higher, et cetera, et cetera.
So it's another normal contango market.
Right. So they're all stretching forward out like that. So if you think about that, first of all, I'm not saying necessarily that these futures are predictive, although in the past, certainly when they were new and they were run, the markets are primarily professional, they were actually quite predictive. Now that we have a lot of, the average public playing in these markets, it's not quite so predictive. But what these are, they're reflecting the implied volatility of SPX options at these various months and times. So, actually 30 days ahead. So the November futures reflect December SPX option premiums. SPX is the most liquid index option on the CBOE, very heavily institutionally traded, period. And that's one of the major components of actually calculating the VIX itself. Then the December futures reflect January options and so forth. So this means that traders are actually paying up a lot in terms of implied volatility, and that's, of course, translates to price, for these SPX options expiring out in December, January, February, March, April, etc. And it's been doing this for a while. Now, when this happens, typically the market it's a sign the market is very overbought. And eventually the market declines, VIX rises, and all these futures begin to rise, with the near-term ones rising faster, and the whole term structure flattens out. And so there are a number of ways you can play this. One, you could just say, well, I'm going to get short the market. Unfortunately, it's not a timing thing, so that's sort of not the ideal way to play it, I would say. If you're going to try to time it that way, you probably would use one of those other things we were talking about. But the term structure can itself be traded by just buying one futures contract or selling another against it. And this is a highly leveraged trade. The exchange minimum margin requirements to do that from 1 month to the next, as long as you're in the first 3 months, is only $625, and the movement is $1,000 a point. So it's really a very interesting way and a highly leveraged way, if you feel confident of market direction, to play it. But, overall, the big picture is that when the term structure gets this steep, we know it's going to have to flatten out somewhere along the way. We just don't know when. I sort of thought maybe after last week's 3 big news items with the election, the FOMC meeting, and the jobs report that might flatten out then. But it really hasn't. It really hasn't. Right now, at this point in time, we've got the April futures trading at about 26, and the as I said, VIX is at 18, and the December futures are trading at about 20.5. So that's a huge differential, and it's indicating just how I would say overpriced maybe you want to say that the longer term options on SPX are. So another way to play it, sometimes the professional players who do this, is just to sell those longer term options out of the money, figuring that even if the market falls and volatility goes up, the volatility of those options is not going to go up all that much, and therefore it's a fairly safe volatility play with a time decay thing built into it. Mm-hmm. But I mean, there are a number of ways. But in general, when it's sloped up as steeply as this, it's usually kind of tag on it. I'm sure that most of the VIX traders really know what that means. The old futures traders do, of course. But it's just reflecting. I think it's reflecting people's worries about what's coming up, and so they're paying up for longer term options as protection. And probably most of the guys who are actually doing that are also long stocks. So it isn't necessarily that they're bearish on the market per se, but they feel the need to have protection in place, and they're paying up for it.
Right, long and nervous. All right, let's see here. We are coming into our last 3 minutes, boy, and I've still got a ton of things I wanted to talk to you about. Tell you what, let's go to this item. You actually mentioned put-call ratios a couple moments ago. I found your comments about the standard put-call ratio versus the weighted put-call ratio to be quite interesting. How about sharing with all of us what the difference is and what it is you found recently, and where can one find the weighted ratio?
Okay. First of all, the standard ratio is just using the volume of puts trade. Like, let's say what you're referring to is the equity-only put-call ratio. In other words, all stock options trade. We calculate that ourselves based on all the option exchanges, but the CBOE on their own website publishes that data for the CBOE.
They do.
So it's all put options that trade on stocks divided by all call options that trade on stocks, just the straight volume. So that's what they call the standard ratio. But then in modern times, since we've got the computers, a better way to look at things is, not only how much volume is being spent on puts and calls, but how many dollars are being spent on puts and calls. So what we do at the end of the day, we take each option price that there is, we multiply it by the number of contracts traded, and that's a dollar-weighted volume, and then we do that. So we sum all that up for all the puts, divide that by all the calls, and that's the weighted ratio. Well, it turns out that recently, because of the same thing we were just talking about, this need for protection, a lot of traders were buying out-of-the-money stock options as protection. And they're fairly cheap because, as we said, also volatility has come down a lot in the market since 6 months ago. So these options look cheap. So they're buying these out-of-the-money cheap options, and that's a lot of volume on the puts. But as far as dollars go, it's not that many dollars. And so the standard ratio started to rise, which would have been a sell signal about 4 weeks ago. But the weighted ratio didn't. And when we saw this discrepancy, that you're talking about the article we wrote about that, and as we went in and looked at things, we said, well, wait a minute, what's causing this? And there's really only one thing that made any sense was that traders were buying out-of-the-money options in size, but they were not buying at-the-money options because the market was going up. So puts, that is, because the markets are going up. So it's pretty clear that the weighted ratio is still telling the true story, whereas the standard ratio was another thing that was being distorted by this, I call it protectionism. Too many people trying to protect their portfolios. Just this week, they've gotten back in sync a bit, but right now I would stick with the weighted ratio. It's not easy to find. I mean, we have it again on that area of our website called the strategy zone. I believe option view calculates it if you have the option view software, and Bloomberg may have a version of it. I'm not 100% sure on that. But since it does require these extra calculations, I don't know of any really free source that actually has it.
Okay. All right. Well, that's all good information. Appreciate you sharing that. Wow. 20 minutes over and done. Amazing. We're going to have to conclude, but is there anything else you'd want to share with us before we go?
No, not really, but I would just say to people out there who are, thinking maybe if this is a great time to start selling puts, it's probably not. Okay. That's great. Larry, thank you for taking the time to join us. We really appreciate that. It's not often we get to hear from somebody like you. Today's guest has been Lawrence McMillan, and that wraps up this week's MTA podcast. From SeattleTechnicalAdvisors.com, I'm Ed Carlson, together with our recording engineer Shane Squark in New York City. Say goodbye, Shane.
We'll see you next time, everybody.
All right, let's keep our stops tight. Good day.